What if your entire retirement fund could be erased by a single weather report? What if the bank holding your mortgage could fail, not because of a bad trade, but because a captain made a wrong turn in a storm? This sounds impossible, right? Finance is supposed to be about ledgers, algorithms, and data. But in the 19th century, the global financial system, the most powerful the world had ever seen, had a fatal secret. It was tethered by a physical rope to the unpredictable, violent sea. How could so much power be so fragile? How could the fate of London bankers be decided by a hurricane 3,000 miles away? And more importantly, is it still?
This is Finance Beyond Seas. We explore the moments where the currents of maritime history and the tides of the global economy collide. We're here to navigate the wreckage of the past, to find the financial lessons that will protect you today. We analyze history and systems, not futures. Nothing presented here is financial advice. It is purely historical and economic commentary.
Our first bearing is the year 1857. The world was booming. The California gold rush was in full swing, and the United States was expanding rapidly, fueled by British capital invested in its new railways. The global economy felt invincible. The system depended on a physical pipeline. Gold, dug from the hills of California, was shipped to Panama, carried across the isthmus, and then loaded onto steamships bound for New York. This gold was not just wealth. It was the lifeblood of the banks. It was the hard asset, the collateral that backed their loans and paper notes. In August 1857, the SS Central America, a reliable 280-foot steamship, left Panama for New York. Her cargo was immense, over 400 passengers and, crucially, an estimated 13 to 15 tons of gold. She was, quite literally, a floating vault. But on September 9th, she sailed into a Category 2 hurricane off the coast of the Carolinas. For 2 days, she fought the storm, but her sails were shredded and she began taking on water. On the night of September 12th, the Central America sank, taking over 420 lives and all 15 tons of gold to the bottom of the Atlantic. The news, traveling by telegraph, hit New York like a cannonball. The gold, which banks were expecting to arrive to cover their liabilities, was gone. The Ohio Life Insurance and Trust Company, a major institution with heavy investments in the railways, suspended payments. It was the first domino. A panic began. The panic in New York instantly crossed the Atlantic. To get cash, American banks and merchants began selling off their assets, primarily British railway stocks, and stopped paying their British creditors. London's market buckled. The Bank of England saw its gold reserves evaporate. The Panic of 1857 became the first truly global financial crisis. The lesson was brutal. The 19th century financial system was a complex machine, but it was physically tethered to a few tons of yellow metal on a single wooden ship. When the ship sank, the trust that held the entire paper economy together sank with it. But it wasn't just the physical loss of cargo that could sink the market. Sometimes the paper that represented the cargo was enough. This brings us to the Panic of 1866 and the failure of Overend, Gurney & Co. This wasn't just any bank. It was known as the Bankers' Bank, a cornerstone of the London discount market. Their business was financing maritime trade. When a merchant shipped cotton from India, that journey took months. The merchant needed cash now. Overend Gurney would buy the bill of exchange, the promise of payment upon delivery, at a discount. They were the financial engine that turned a future promise of cargo into present-day cash. The problem was they got reckless. They began using this safe, short-term money to make risky long-term investments in railways and other ventures. When those ventures failed, they were suddenly unable to cover the shipping bills they had guaranteed.
On May 10, 1866, Black Friday in London, the firm collapsed. Credit across the British Empire froze. This time, the ship didn't sink. The financial instrument that represented the ship turned to dust. The risk had moved from the sea to the ledger. The pattern evolved again. The risk was no longer just a single ship or the paper for a single voyage, but an entire overseas venture. We sailed to 1890 and the Baring crisis. Baring's Bank was one of London's oldest and most prestigious institutions. They had financed empires. In the 1880s, they went all in on a seemingly perfect investment, Argentina. They financed the construction of ports, railways, and utilities, underwriting massive amounts of Argentine bonds. But in 1890, a revolution in Argentina caused the economy to crash and the government to default on its debts. Suddenly, Barings was left holding a mountain of worthless paper. This was different. This wasn't one ship of gold. This was the equivalent of an entire fleet of investments sinking at once. The Bank of England had to orchestrate a massive, secret bailout by other banks to prevent a total system meltdown. The pattern was now clear. London's financial fate was no longer just tied to a ship, but to the stability of the foreign ports it financed. Fast forward to today. Haven't learned anything. The ships are 200,000-ton steel titans, and the paper is complex digital code. But the choke points remain. We don't even need a ship to sink anymore. Look at the events in the Red Sea starting in late 2023. A series of attacks in a narrow strait, the Bab el-Mandeb, effectively created a geopolitical storm, shutting down one of the world's most critical trade arteries. This wasn't a natural hurricane, it was a man-made one. The world's largest shipping companies were forced to reroute their entire fleets, adding weeks of travel time and billions of dollars in fuel and insurance costs by sailing around Africa. What was the result? The instant the threat was confirmed, algorithms priced that risk into oil futures and shipping stocks. The delay of components from Asia immediately threatened factory output in Europe and America. What took weeks for the news of the Central America to do now happens in minutes. The pattern is clear. Our global financial ship is more complex than ever, but it is still reliant on the physical movement of goods across water. Our hyper-efficient, just-in-time supply chain is just a 21st century word for extremely fragile. We've simply built a taller, more leveraged tower on the same shifting deck. What does this mean for you? It means that a conflict thousands of miles away isn't just an abstract headline. It's not someone else's problem. It is the price of your fuel going up. It's the rising cost of the goods you buy every day. It's the inflation that silently eats away at your savings.
The risk is that your personal financial stability is tied to events you cannot control, in places you may have never heard of. The investors in 1857 thought their American railway stocks were safe. The investors in 1890 thought Argentine bonds guaranteed by Barings were as good as gold. They were all wrong. Being unprepared means your savings, your investments, and perhaps even your job are the shock absorbers for the next global crisis. It means your personal financial ship is tethered to the flagship of the global economy. And when that flagship hits a storm, it will pull you down with it. The cost of not understanding this is to have your personal wealth become the wreckage. So how do you build a personal lifeboat in this global ocean? This is commentary, not advice, but the lessons from history are clear. The individuals who survived the 19th century panics were those who understood the risks. First, the lesson of the SS Central America is to beware of single points of failure. In personal terms, this is the classic case for diversification. The investors who were wiped out were those who had all their gold on one ship. Second, the lesson of Overend, Gurney, is to understand what you own. The people who held their paper thought it was safe, but it was backed by risky, unseen ventures. Do you know what backs your assets? Is your wealth in a digital bank that is as over-leveraged as a 19th century discount house? Understanding counterparty risk is crucial. Third, the lesson of all these panics is the value of the tangible versus the intangible. When the paper systems of credit froze, tangible assets, property, commodities, and practical skills retained their value. This doesn't mean to shun the modern system, it means to build resilience. Having practical skills, a strong personal network, and a portion of your savings in assets that are not just digital promises on a screen, this is the foundation of a ship that can weather a storm. Resilience, not speculation, is the key to surviving the financial seas. We have sailed from the 19th century to the 21st, only to find the same ocean. The ships are bigger, the cargo moves faster, and the financial instruments are infinitely more complex. But the storms are just as fierce. The Greek philosopher Heraclitus noted that no man ever steps in the same river twice. The river changes, and so does the man. History is the same. The water is always new, but the currents of human nature, leverage, and unexpected shocks are timeless. The sea doesn't care about your portfolio's projections. The global financial system is the most complex ship ever built, but it's still just a ship sailing on the same unpredictable seas. Assume it will be tested. Your financial security is your own. Build it to withstand the waves. Be the lighthouse, not the wreckage. If this voyage into the past gave you a new chart for navigating today's risks, subscribe to Finance Beyond Seas. We are here to explore the hidden currents that connect history to your financial world. We want to hear your thoughts in the comments. What do you believe is the single biggest point of failure in our modern global economy? Is it a microchip factory, or perhaps a reserve currency? More importantly, what steps are you taking to make your own financial life more resilient against the storms?